There is one chart right now that changes everything you think you understand about the silver market. It is not trending on financial television. It is not being debated by the usual Wall Street strategists. And it is certainly not being highlighted in mainstream headlines. But it should be. That chart tracks silver inventory levels at the Shanghai Futures Exchange. And what it shows is not subtle. China, one of the largest consumers of silver on the planet, has drained its exchange warehouse inventories down to just 350 tons. That is the remaining supply sitting inside the Shanghai vault system. From a peak of roughly 3,000 tons recorded in January 2021, inventories have collapsed by 88%. 88% in roughly 5 years. Read that again in your mind. Nearly 9/10 of exchange silver in Shanghai is gone. And yet the financial media continues to treat silver like a routine commodity. They focus on the recent 40% pullback from the highs. They call the volatility proof that the rally is over. They tell investors to remain calm and stay positioned in conventional paper assets. That narrative ignores the data. Let's walk through what is actually happening beneath the surface, because once you connect the pieces, the picture becomes much clearer. Silver moved decisively back above $83 per ounce this week, climbing more than 3% in a single session. The immediate trigger was weak U.S. retail sales data that came in flat and below expectations. That single report raised renewed concerns about the durability of U.S. economic growth. When economic indicators soften, pressure increases on the Federal Reserve to consider rate cuts. Lower rates generally weaken the dollar, and a weaker dollar tends to support commodities priced in dollars because they become more attractive to international buyers. That is the immediate macro backdrop. The dollar is facing pressure. Precious metals are gaining bids, and silver, due to its historically high volatility, is amplifying those moves. But the retail sales data is not the core story. The core story is structural. According to projections from the Silver Institute, 2026 will mark the 6th consecutive year in which global silver demand exceeds total supply. 6 straight years of deficit. 6 years where the market has consumed more metal than it has produced. 6 years where above-ground inventories have been drawn down to fill the gap. For this year alone, the projected shortfall stands at 67 million ounces. That is not a marginal imbalance. That is a sustained structural deficit of meaningful scale, and it is happening in an environment where industrial demand continues to accelerate across multiple sectors. The photovoltaic industry requires silver paste for solar panel production. Every panel installed contains silver as a key conductive material. As countries race to expand renewable energy capacity, solar installations are growing at exponential rates. Electric vehicles represent another demand engine. Modern EVs contain silver in their electrical systems, charging components, and battery management architecture. On average, electric vehicles use more silver than traditional internal combustion vehicles. As global EV adoption expands, incremental silver consumption rises with it. Artificial intelligence infrastructure adds a newer layer of demand. Data centers require servers. Servers require high-performance electronics. Electronics require silver. The expansion of AI computing capacity over the past few years has created a demand segment that barely existed half a decade ago. Defense and aerospace systems also rely on silver for advanced electronic components. Demand is not concentrated in one niche. It is diversified and growing. Now think about what happens when demand grows for 6 consecutive years while supply fails to keep pace. Inventories decline, which brings us back to Shanghai. In January 2021, the Shanghai Futures Exchange warehouses held approximately 3,000 tons of silver. Today, inventories have fallen to roughly 350 tons. That 88% decline did not occur gradually in isolation. It accelerated as substantial volumes of silver were exported from China to London and Western markets throughout 2025. Chinese metal flowed outward to meet global demand. The result is visible in the warehouse numbers. The domestic exchange vaults are running near decade lows. This is not theoretical. It directly affects industrial users inside China, solar manufacturers, electronics producers, EV component suppliers. They all rely on accessible physical silver. When inventories are high, markets function smoothly. Buyers can source metal without dramatic price spikes. Sellers meet demand at relatively stable levels. When inventories are critically low, the dynamic changes. Even modest surges in buying pressure collide with constrained supply. Prices react sharply because there is limited metal available at intermediate price points. That is what we saw when silver surged to $120 per ounce earlier this year. The market did not climb slowly, it jumped. And then, within days, it fell nearly 40% back into the low 80s. Many observers interpreted that drop as a sign that the bull market had failed. But sharp spikes followed by violent corrections are often characteristic of tight physical markets. When supply at certain price levels is thin, prices can gap higher quickly. When speculative excess clears, prices can correct just as rapidly, but the underlying structural tightness does not automatically disappear. Shanghai inventories remain near 350 tons. The projected annual deficit remains 67 million ounces. The 6-year streak of supply shortfalls remains intact. Nothing fundamental in the supply-demand equation has reversed. Now consider the distinction between gold and silver. Gold's demand is largely monetary. It serves primarily as a store of value and hedge against currency risk. Silver carries a dual identity. It is both a monetary metal and an industrial input. Roughly 60% of silver demand originates from industrial applications, and those applications are expanding at a time when mine supply growth is constrained. The photovoltaic sector alone absorbs enormous volumes of silver annually. Even with efficiency improvements that reduce silver usage per panel, total installations are increasing at a pace that offsets those reductions. Electric vehicle production continues ramping globally. Charging infrastructure expansion adds incremental demand. Artificial intelligence infrastructure construction is accelerating as major technology firms invest heavily in computing capacity. Each server cluster, each data center build-out, carries embedded silver demand. 5 years ago, AI-driven silver consumption was minimal compared to today. Now it is a measurable factor. This new demand layer emerged while the market was already in deficit. That is the context many commentators overlook. Short-term price movements are visible. Structural imbalances are quieter. And when you align a 6-year deficit, 67 million ounce shortfall projections, and an 88% collapse in Shanghai inventories, the story becomes difficult to dismiss. Now let's examine the analyst landscape, because the range of price projections right now is not just wide, it is extreme. And when professional forecasts diverge this sharply, it usually signals that we are not in a normal environment. On one side, you have major financial institutions presenting relatively conservative outlooks. Goldman Sachs is projecting an average silver price in the range of $75 to $85 per ounce for 2026. JP Morgan's forecast sits near $81 on average. These banks operate with complex econometric models, macro overlays, and long historical data sets. Their projections assume markets remain orderly and that supply and demand gradually rebalance within predictable boundaries. On the other side of the spectrum, you have analysts who are looking at the same supply data and arriving at dramatically different conclusions. Michael Oliver has suggested that silver could reach somewhere between $300 and $500 per ounce during this cycle. David Hunter has pointed to a potential move toward $180 by the second quarter. Those are not small differences in opinion. They reflect fundamentally different assumptions about how this market will behave under stress. The conservative forecasts assume relatively stable conditions. They assume recycling increases meaningfully if prices rise. They assume manufacturers successfully thrift and substitute away from silver when costs climb. They assume price volatility remains contained within historical norms. In short, they assume that markets function the way they have in the past. But here is the problem. Current conditions do not resemble the past. Shanghai exchange inventories are sitting near decade lows at 350 tons. The market is entering its 6th consecutive year of supply deficit. The projected annual shortfall remains 67 million ounces. China exported record volumes of silver in 2025 while depleting domestic stockpiles. Industrial demand from solar panels, electric vehicles, artificial intelligence infrastructure, and defense systems continues to grow. Meanwhile, London's physical market has shown signs of tightness, and COMEX registered inventories have trended lower. Those are not neutral conditions. When markets move outside established historical ranges, traditional forecasting models can fail because they assume equilibrium where none exists. The more aggressive price targets assume that the physical market eventually overwhelms the paper pricing system. They assume that inventory constraints lead to disorderly price discovery. They assume that volatility expands as supply buffers thin out. When silver surged to $120 per ounce and then fell nearly 40% within days, that was not typical commodity behavior. That was stress behavior. Stress behavior in a structurally tight market can be an early sign of repricing. Now let's address the bearish case directly, because any serious analysis requires examining both sides. First, the Federal Reserve remains a wild card. Weak retail sales data increases the probability of rate cuts, but the Fed has shown caution in shifting policy. If inflation unexpectedly reaccelerates, or if policymakers adopt a more hawkish tone, precious metals could face short-term pressure. Higher rates increase the opportunity cost of holding non-yielding assets like silver. Second, Shanghai's low inventories do not necessarily mean the world has run out of silver. Chinese silver exports in 2025 reached a 16-year high. That metal flowed into London and other Western markets. From a global perspective, silver may not be uniformly scarce. It may simply be unevenly distributed. Third, thrifting and substitution are real dynamics. Solar panel manufacturers are actively reducing the amount of silver required per unit. Alternative materials are being explored. The Silver Institute has acknowledged that efficiency gains could slow photovoltaic silver demand growth over time. These are legitimate considerations. Now, here is the counterbalance. Yes, the Federal Reserve is unpredictable, but macroeconomic indicators are softening. Retail sales were flat. Labor market momentum is cooling. Inflation, while still present, is decelerating compared to prior peaks. The longer-term trajectory still leans toward eventual policy easing. Historically, rate cuts support precious metals by weakening the dollar and reducing real yield competition. Yes, Chinese exports were elevated, but exporting metal does not eliminate a deficit. It redistributes it. Silver leaving Shanghai filled demand elsewhere. The global shortfall of 67 million ounces remains. Moving inventory from one warehouse to another does not create new supply. And yes, thrifting is occurring. But scaling alternative technologies takes years. Silver-free solar solutions are still developing and are not yet deployed at global scale. Even if silver intensity per panel declines, total installations continue expanding at a pace that can offset those efficiency gains. Electric vehicle production is increasing, charging networks are expanding, artificial intelligence infrastructure is scaling rapidly as companies build new data centers to support advanced computing needs. Demand drivers are accelerating. Now consider a key structural element that many overlook. Approximately 70% of silver production comes as a byproduct of mining operations primarily focused on copper, zinc, lead, or gold. Silver is not the primary economic driver for most mines. That means higher silver prices alone do not automatically generate rapid supply increases. Production decisions are often tied to base metal economics. If copper or zinc prices are weak, those mines may not expand output significantly even if silver is strong. If base metal projects stall, silver supply growth can stagnate. Opening new primary silver mines is not a short process. It requires exploration, permitting, financing, environmental approval, and construction. That timeline can stretch across many years. Supply response is slow. This inelastic supply dynamic is crucial. It means deficits can persist longer than many models anticipate. Now let's revisit the historical context. In 1979 and 1980, the Hunt brothers attempted to corner the silver market. Prices surged from under $6 to around $50 per ounce in less than a year. The rally collapsed after exchanges raised margin requirements and forced liquidation. That episode demonstrated how violently silver can move when physical supply becomes tight and speculative interest intensifies. Today's environment is not driven by a concentrated effort from a single group of investors. It is driven by structural industrial demand layered on top of monetary demand in a world of expanding debt and currency uncertainty. That distinction matters. There is no singular event that can simply reverse a structural deficit. Instead, there is a slow accumulation of pressure that builds beneath the surface. Now consider the gold to silver ratio. Historically, the ratio has averaged around 60 to 1. During monetary stress, it has compressed dramatically, sometimes toward 15 to 1. In early 2020, amid extreme market dislocation, the ratio spiked above 100 to 1, signaling severe relative undervaluation of silver. Recently, the ratio fell below 50 to 1 for the first time since 2012. That compression indicates silver is outperforming gold. In precious metal cycles, silver often leads during the stronger phases of a bull market due to its higher volatility and industrial linkage. When silver begins to outperform gold decisively, it can signal a broader shift in sentiment. Now consider the near-term catalysts. Upcoming inflation data could influence short-term price movements. A softer print could strengthen expectations for rate cuts and support a move back toward recent highs near $100. A hotter print could introduce temporary volatility, but short-term data releases do not change the structural picture. The 67 million ounce deficit remains projected. Shanghai inventories remain near 350 tons. The 6-year deficit streak continues. Industrial demand from solar, EVs, and AI continues expanding. Supply remains constrained by byproduct mining economics. Markets can fluctuate around these fundamentals, but they do not erase them. The recent consolidation between $80 and $85 appears more like digestion than collapse. After a dramatic run from $30 to $120, some degree of profit-taking and repositioning is natural. Markets rarely move vertically without pauses. The broader framework still shows a multi-year trend supported by persistent structural imbalance. Now let's widen the lens and place silver inside the larger global financial structure, because this is not just a commodity story. It is a monetary story unfolding at the same time as an industrial transformation. We are operating in a world where sovereign debt has expanded at a pace that far exceeds long-term economic growth. Government deficits continue rising. Interest expenses on that debt are climbing. Central banks are navigating a narrow path between controlling inflation and preventing economic contraction. The Federal Reserve, like other central banks, faces a structural dilemma: keep rates elevated and risk slowing growth further, or cut rates and risk weakening the currency and reigniting inflationary pressures. Neither path is comfortable. Both introduce volatility. Foreign central banks have been adjusting their behavior accordingly. Treasury holdings have shown diversification trends. Gold purchases by central banks have reached record levels in recent years. Nations within the BRICS framework are actively exploring payment systems that reduce reliance on dollar settlement mechanisms. These developments signal a gradual shift in the global monetary order. Silver exists at the intersection of that monetary uncertainty and the accelerating industrial economy. The volatility you see in silver is not random noise. It is a market negotiating new equilibrium conditions in real time. The 40% decline from $120 down into the low 80s was sharp and uncomfortable. But context matters. Even after that correction, silver remains dramatically higher than it was just a year ago. It remains far above its levels from 5 years ago. The broader trajectory has not reversed. Now return to the measurable data. Shanghai warehouse inventories are near 350 tons, down 88% from approximately 3,000 tons in January 2021. The global market is heading into its sixth consecutive year of supply deficit. The projected shortfall for the current year stands at 67 million ounces. The gold to silver ratio has compressed below 50 to 1. Industrial demand from solar panels, electric vehicles, artificial intelligence infrastructure, and defense systems continues expanding. Those are structural realities. Markets can fluctuate around them, but they do not erase them. Let's examine industrial demand again because it remains central to this thesis. Global solar installation growth remains robust as countries push renewable targets. Each panel installed contains silver paste as a critical conductive element. Even as manufacturers reduce silver intensity per unit, the absolute number of installations continues rising, sustaining aggregate demand. Electric vehicle production continues expanding worldwide. Charging infrastructure growth compounds incremental silver usage. Battery management systems and power electronics rely on silver's conductive properties. Artificial intelligence infrastructure construction has accelerated rapidly. Hyperscale data centers require extensive server arrays. Servers require advanced electronic components. Those components rely on silver. 5 years ago, AI-driven silver demand was marginal. Today it is material. Defense and aerospace industries also depend on silver for specialized electronics, where reliability and conductivity are non-negotiable. Demand growth is diversified across sectors. It is not a single source phenomenon that can simply disappear. Now contrast that with supply characteristics. Roughly 70% of global silver production is generated as a byproduct of mining operations primarily focused on copper, zinc, lead, or gold. Silver output is therefore heavily influenced by base metal economics. If copper or zinc prices weaken, silver supply growth can stall regardless of silver's own price performance. Primary silver mine development requires long timelines involving exploration, environmental approval, financing, and construction. New supply does not come online quickly. This supply inelasticity is fundamental. When demand accelerates across multiple sectors and supply responds slowly, deficits persist. The market must eventually rebalance either through significantly higher prices that incentivize new production or through price levels that suppress demand. That is the tension underlying current price behavior. Now consider the psychological dimension. For years, silver underperformed broader equity markets. Many investors dismissed it as stagnant or overly volatile. That perception is shifting. As price momentum returned and structural deficits gained attention, silver re-entered investor awareness. Volatility can repel participants in the short term, but it can also attract attention and liquidity. The surge to $120 per ounce demonstrated how rapidly price discovery can change when tight supply meets strong demand. The subsequent correction flushed speculative excess, but did not resolve the structural imbalance. In many historical cycles, sharp corrections occur within broader advances. Now factor in macroeconomic uncertainty. Retail sales data recently came in flat. Labor market indicators show signs of cooling. Fiscal deficits remain elevated. Debt servicing costs are climbing. Inflation has moderated but remains sensitive to energy, supply chains, and policy decisions. If rate cuts occur, the dollar could weaken further, supporting commodities priced in dollars. If inflation surprises higher, currency purchasing power concerns may intensify, which historically benefits tangible assets over extended periods. Either scenario introduces volatility, but both scenarios contain supportive elements for precious metals over time. Let's also acknowledge geopolitical risk. Trade tensions remain present. Resource nationalism has increased in some mining jurisdictions. Environmental permitting constraints slow project development. Political instability can disrupt supply chains. These factors add friction to supply growth. At the same time, policy-driven industrial mandates push demand upward. Decarbonization initiatives, electrification strategies, digital infrastructure expansion, and defense modernization are multi-year commitments. Demand growth in these areas is not discretionary in the short term. When structural industrial demand intersects with monetary uncertainty and constrained supply, price discovery becomes more dynamic. The recent consolidation between $80 and $85 may represent recalibration rather than exhaustion. Markets rarely move in straight lines. After a dramatic run from $30 to $120, pauses are natural. Profit-taking and repositioning are part of any healthy trend. The essential question remains unchanged. Does the structural deficit persist? Do inventories remain tight? Does industrial demand continue growing? So far, the answer to all three is yes. Silver's dual identity as both a monetary and industrial metal amplifies its role in a transitioning global system. It is tied to technological expansion and to currency confidence at the same time. The gold-to-silver ratio compressing below 50 reflects relative strength. When silver begins outperforming gold, it often signals increasing investor participation in the precious metals complex. Look again at the hard numbers. 350 tons in Shanghai warehouses, an 88% drawdown from peak levels, 6 consecutive years of deficit, a projected 67 million ounce annual shortfall, industrial acceleration from solar, EVs, AI, and defense sectors. Supply constrained by byproduct mining dynamics. These are not speculative narratives, they are measurable trends. Markets can ignore structural imbalance for a period of time, but eventually price reconciles it. The volatility seen this year is part of that reconciliation process. Silver remains one of the most structurally undersupplied tangible assets in the current financial landscape. As awareness grows and capital flows adjust, price discovery will continue evolving. The opportunity lies not in predicting daily moves, but in understanding the structural forces at play. Monitor inventory levels, watch deficit projections, track industrial demand trends, observe central bank behavior and monetary policy shifts. Because when multiple reinforcing forces converge, monetary stress, industrial expansion, supply inelasticity, and inventory depletion, markets rarely remain static. They reprice, and that repricing can happen faster than most expect.